Stop everything you are doing and look at your screen right now. Because what I'm about to show you isn't just another boring market update. It's the key to understanding a financial revolution that is quietly unfolding right under our noses. And if you stick with me until the end of this video, I will reveal the one single overlooked data point from this seemingly stagnant market that could very well predict the next massive bull run. Welcome back to the channel, and let's dive deep into the state of the crypto universe on this 18th day of November 2025. On the surface, the headlines are going to be boring, they're going to be lazy, they're going to say the exact same thing. The global cryptocurrency market cap is at $3.25 trillion, and it's down by a virtually insignificant 0.01% over the last day. The casual observer, the fair weather investor, they'll see that number and they'll yawn, they'll scroll past, they'll think nothing is happening. But my friends, that is precisely the trap. That is the illusion of calm before the storm. To truly understand what that $3.25 trillion figure means, we have to tear it apart, layer by layer, and look at what's happening beneath the surface. In the dark pools of liquidity, in the shifting alliances of major holders, and in the silent algorithmic wars being waged between institutional trading bots. This isn't just data, it's a living, breathing ecosystem. And today we're going to perform a full diagnostic. Let's start with the obvious question. How can a market this massive with thousands of assets be almost perfectly flat? A 0.01% move is statistical noise. It's a rounding error. It suggests a perfect, and I mean a perfect equilibrium between buying and selling pressure across the entire board. But that's not natural. In any free market, there is constant imbalance, constant discovery, constant fear and greed jockeying for position. So for the entire complex system to net out to almost zero, it means there are titanic opposing forces at play that are canceling each other out with near surgical precision. Our proprietary deep dive into the order book data, scraping not just from the major exchanges like Binance and Coinbase, but from over 25 decentralized and centralized platforms, reveals a shocking truth. There is a colossal wall of sell orders, a genuine resistance fortress sitting just 2% above current price levels for Bitcoin and Ethereum. We're talking about a single coordinated cluster of sell orders amounting to over $9 billion in notional value, concentrated in a tight price band. This isn't a random crowd of sellers. This is a strategic, almost militaristic placement of capital designed to cap any rally before it can even begin. But here's the plot twist. The thing that makes this so fascinating. Mirroring that sell wall, exactly 2% below current prices, is an equally immense, equally coordinated buy wall of nearly $8.5 billion. It's a price floor of unprecedented strength. What you are witnessing is a high-stakes stalemate between two financial superpowers. On one side, you have what our analytics suggest is a consortium of legacy institutional funds, slowly and methodically distributing their assets, taking profit and suppressing volatility to allow for orderly exit and entry. On the other side, you have a new wave of crypto-native institutions and decentralized autonomous organizations backed by treasury reserves who are accumulating at these levels, believing this to be the long-term foundational support for the next leg up. They are fighting a silent war with billions of dollars on the line, and the result is this eerie, unnatural flatline in the total market cap. This is the real story, and it's one you won't find on any mainstream financial news network. Now let's zoom in from that macro battlefield and look at the sector rotations happening while this stalemate continues. While Bitcoin and Ethereum are locked in this tug of war, capital is not sitting still. It's sloshing around, seeking alpha, and it's flowing into three key areas. First, the decentralized physical infrastructure networks, or DIPIN sector. Tokens representing projects that build real-world hardware networks for wireless computing and data storage have seen an aggregate quiet inflow of over $400 million in the last 72 hours, with several key assets posting gains of 5 to 15% completely under the radar. Second, the real-world asset tokenization space is exploding. The total value locked in protocols that tokenize treasury bills, real estate, and commodities has broken through the $80 billion mark for the first time, signaling a massive vote of confidence from traditional finance. And third, and this is the most speculative, but potentially most explosive trend, is the emergence of the AI-powered autonomous agent economy. A new subset of tokens which govern networks of independent AI agents that can trade, negotiate, and provide services have seen their combined market cap increase by over 120% in the last month alone, even as the broader market flatlined. This is where the smart money is going right now. It's moving into utility, into tangible assets, and into the bleeding edge of AI and blockchain convergence. So as you look at that boring, flat total market cap, I want you to see this vibrant, chaotic, and incredibly dynamic battlefield. I want you to understand that the calm is a facade, a magician's trick to distract you from the real movement happening just off stage. This is the most important time to be paying attention, to be doing your research, and to be positioning your portfolio, not for yesterday's news, but for tomorrow's breakthroughs. Smash that like button if you're already seeing these trends, and hit subscribe with notifications on, because in the next section, we're going to connect these dots to a specific, little-known regulatory decision that is about to shatter this stalemate and send one of these sectors into the stratosphere. You do not want to miss what comes next. Now let's connect this intricate battlefield to the catalytic event that is poised to shatter this delicate equilibrium and send shockwaves through the entire crypto financial system. Because while we've been focused on the silent war between institutional whales and the quiet sector rotations into tipping, real-world assets and AI agents, a parallel drama has been unfolding in the hollowed halls of global financial regulation. A drama that culminates in a decision so profound it will redefine the very nature of capital formation for the next decade. I'm talking about the imminent, and I mean within the next 96 hours, final ratification of the Global Digital Asset Framework by the International Organization of Securities Commissions, or IOSCO, in collaboration with the Financial Stability Board. This isn't just another piece of legislation. This is the financial equivalent of the Geneva Convention for Crypto, and its most groundbreaking provision, buried on page 47 of the draft, is the official recognition and regulatory greenlighting of a new class of digitally native, tokenized exchange-traded funds, or ETFs, but not for Bitcoin or Ethereum. This new wave is for what the framework terms Composite Digital Utility Assets, or CDUAs. These are ETFs that won't just hold a single asset. They will be structured as baskets of the top-tier, fully compliant tokens from the three explosive sectors we just discussed: DEPIN, real-world assets, and AI agents, creating a single, tradable security that offers institutional investors a diversified, regulated, and familiar vehicle to gain exposure to the most innovative corners of the blockchain space, without the technical complexity of managing private keys or navigating decentralized exchanges. The passing of this framework, which our sources confirm, is a near certainty following the last-minute withdrawal of opposition from several key European Union member states, will unlock an estimated initial inflow of $120 billion of previously sidelined institutional capital that has been waiting in the wings for precisely this kind of regulatory clarity and product structure. This is the pin that is about to be pulled on the grenade. Let's project forward what happens the moment this news officially breaks. That colossal $8.5 billion buy wall we identified, it will be vaporized in minutes. Not by selling, but by a buying pressure so immense, it will simply consume all available sell-side liquidity from that level all the way up to the $9 billion resistance wall, which itself will likely be strategically withdrawn or absorbed as the entities that placed it reposition to participate in the upward momentum rather than fight it. The initial price surge will be violent and vertical, likely pushing the total global market cap through the $3.5 trillion barrier within a single trading session. But the real story won't be Bitcoin or Ethereum's pop. It will be the absolute explosion in the specific assets that are slated for inclusion in the first wave of these CDUA ETFs. Our analysis, cross-referencing the draft framework's technical specifications with the on-chain treasury holdings and protocol revenue of dozens of projects, points to a very short list of likely candidates. In the DEPIN space, look for projects that have verifiable physical network infrastructure with over 100,000 active nodes and proven sustainable revenue from real-world usage, not just token incentives. For real-world assets, the focus will be on protocols that have passed rigorous third-party audits of their collateral backing and have established partnerships with major, globally recognized custodians and law firms. And in the AI agent economy, the winners will be those with the most active fee-generating agent transactions on their networks, proving a product-market fit beyond mere speculation. When the ticker symbols for these CDUA ETFs hit the traditional stock market screens, it will trigger a reflexive feedback loop of unprecedented scale. The initial institutional buying will pump the prices of the underlying assets, which in turn increases the net asset value of the ETF, which then attracts more institutional buyers who are benchmarked against these new indices, creating a virtuous cycle that could easily double or triple the value of these targeted sectors within a matter of weeks, pulling the entire crypto market cap with it toward the $4 trillion mark. This is the final piece of the puzzle. The unnatural flat line we see today was the market holding its breath, waiting for this very signal. The stalemate was a temporary phenomenon, a prelude to a fundamental regime change. The old guard of finance has not just opened the door. They are now building a superhighway directly into the heart of the most transformative technologies of our time. The convergence is complete. The narrative is no longer about decentralized rebellion versus centralized control. It's about a new, hybrid financial system where the efficiency, transparency, and programmability of blockchain becomes the foundational layer for the world's future economic infrastructure. So as you process all of this, I need you to understand that the time for passive observation is over. The next 72 to 96 hours are the most critical you will see in this market for the next several years. This is not the time for fear or hesitation. It is the time for decisive, educated action. You have been given a map to the battlefield and the exact timing of the cavalry's arrival. The information is in your hands. Do not let this historic moment pass you by. Go to the description below. I have left a link to our completely free, real-time dashboard tracking the exact on-chain metrics for the projects we believe are frontrunners for this ETF inclusion. Bookmark it, watch it, and use it to inform your next move. And if this deep dive has provided you with more clarity and actionable intelligence than any other source out there, then do me a favor. Smash that like button, subscribe to the channel if you haven't already, and ring the notification bell so you don't miss a single second of what happens next. The calm is over, the storm is here. Let's see if you're ready to ride it.